Most traders think that stock options are just a cheap way to play big up moves on stocks by buying cheap call options. But what most traders are missing is that options are an incredible potential source of consistent cash income. This potential consistent cash is available to almost every trader and investor if they learn just a few basic options trading strategies that can be understood in a few minutes. In this video, we will share 3 of the best option strategies for earning consistent monthly income. You can immediately implement these in your online broker account, just like many great money managers and traders do daily. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree. This is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Froyberg. I'm the head trader of SMB Capital's options trading desk here in Manhattan. And we've got traders and investors from all over the world asking us to share with them the techniques that we use to produce cash income for our accounts. And the truth is that all of these strategies are really very easy to understand, but most traders just never take the time to learn how they work, after which they can very quickly begin to use them to produce monthly income for themselves. So let's go ahead and dive in. Most people have this impression that the best way to trade options is to pick a stock that you're really bullish on and go out and buy a cheap call option at a tiny fraction of the cost of that stock and put yourself into a position of making good money if that stock rallies. Or buying a cheap put option on a stock that you're bearish on, and then instead of taking the big risk of shorting the shares, they can make good money because the put will gain value if the stock does in fact sell off. But very few traders ever think of turning that whole idea upside down, and instead of buying options to make money from big stock moves, instead of that, they rarely think about selling options and collecting the cash that you'll immediately receive through selling options. And this video is really about that whole process of selling options for cash income. And in order to explain how this strategy works, we need to make sure that you understand how stock and index options work. And if you're new to options trading and don't know what stock and index options are or how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for understanding the strategy we'll be teaching you in the video. Then when you're finished, you can come back and watch the rest of the video. The first option strategy for cash income is known as the cash secured put. And let's show you an example of how a cash secured put works. So let's head back to June 1st, 2023. And as you can see on that day, Exxon, which trades under the ticker symbol XOM, was in the midst of a sell-off since early May, and it was approaching what some traders would recognize as a pretty reliable support area, that 97 to 99 price, from which it bounced multiple times since October of 2022. And so let's say that you determined that you'd be happy to own those shares at a price of $99 per share, because every time it hit that price recently, it bounced and you would have made a nice profit. And so suppose on that day, with Exxon trading at 101.56, you went out to an options chain that expired at the end of June, and you went ahead and sold 5 puts at the 99 strike price, which were selling for a price of about $2.18. Now, if you did that, you'd be entering into a cash secured put position. And what that means is that if Exxon were to close on June 30th, the day the options expire, at any price below 99, you'd be required to buy 100 shares of Exxon for $99 per share for each option that you sold. And since you sold 5 of them, you'd be required to buy 500 shares of Exxon. And so let's analyze what happened here from a cash flow standpoint. And as you can see from the calculation, you're receiving $2.18 for the put options. But remember, each put option represents 100 shares of stock. So you multiply that by 100 and you sold 5 of them. And so the resultant cash flow, which your broker will immediately deposit into your account would have been $1,090. And your broker would require you to have $49,500 in your account so that if the stock closed below 99 on the day that those options expired, you'd need to buy those 500 shares at $99 a share. And so your broker wants to make sure that you can meet that obligation. Now, let's move forward to June 30th. And as you can see, the stock bounced and on the final trading day of June had actually closed at 107.25. And so the implications of this are that with the stock closing at 107.25, then those puts expire worthless, right? Because who's going to exercise the right to sell their shares at 99 when the stock closed more than 8 points higher? Obviously, that's not going to happen. And so the puts just expire worthless and the trader simply pockets that $1,090 that he received for selling them a month earlier, which is a return of 2.2% in a month. And so if he does a similar trade every month, locating the puts at a price below the current trading price of the stock and collecting a price of 218 or more for each of the puts, that would translate into a whopping 26.4% return per year on that capital, or $13,080 a year, simply by selling cash secured puts each month. Now remember, if the stock had closed below 99, then you would have been required to buy those shares, but you had already made the decision that you were happy to buy those shares at 99 because the likelihood was that the stock would have bounced at that price anyway, and you would instead make a great profit on the shares. And that's why the cash secured put strategy is known as a win-win strategy, because you either profit from the cash we got selling the puts, as we did in this case because the stock closed above that put's strike price on expiration day, or you own the shares at a price that is very attractive and very likely gives you a great long stock trade. And in fact, that's why some of the greatest investors in the world, including Warren Buffett, use cash secured puts at the time to position themselves to win either way. Okay, so now let's delve into our second cash flow generating strategy, and that's known as the covered call strategy. Now, most investors and traders own common stocks in their own accounts, and some of the greatest growth stocks, like Tesla, simply don't pay a dividend. And so most traders just accept that the portion of their portfolios dedicated to these growth stocks that don't pay a dividend are just not going to produce any ongoing cash flow for the investor while he owns the stock. And that can be frustrating for investors who want cash flow from all of their investments. And that's where the covered call strategy comes in. Let's say, for example, that we owned 200 shares of Tesla on February 1st, which was trading at 181.41 that day. Well, the value of those shares would be 36,282. So let's say that on that day, owning those 200 shares, you went ahead and sold 2 of the Tesla 200 strike price calls for a price of $7.62. Well, if you did that, you'd be executing what options traders refer to as a covered call trade. Okay, so in this case then, as you can see from the calculation, once you sell those calls, your broker will immediately deposit into your account $1,524, and you get to keep that cash no matter what. Now, let's move forward to the day that those 2 puts expired on March 3rd. And as you can see, Tesla closed at 197.79 that day. And so let's examine what happened to our 2 calls up at 200. And as you can see, with the stock closing at 197.79, the 2 calls up at 200 expire worthless because there's obviously no value to a right to buy shares of Tesla at 200 when you can go into the open market and buy them for more than $2 less than that. So those calls just expire worthless, which means that, again, the trader can just go ahead and pocket the $1,524 of premium he received a month earlier and do it all over again if he wishes for options expiring in April. If he did a similar trade each month, it would result in an unbelievable annualized return of over 50% and an annual cash flow of over $18,000 on his 200 Tesla shares. It's important to realize that had the shares closed above 200, the guy you sold the call to would no doubt exercise his right to buy those shares at 200, and you would no longer own the Tesla shares. In that case, if you wanted to continue to glean income from your Tesla shares each month, then you simply rebuy the shares and initiate a new covered call transaction for early April a month later, and just continue doing this every month if you're looking for cash flow from non-dividend yielding stocks like Tesla. And now, yet another way the traders make cash income is by utilizing a simple option strategy known as the credit spread, which is often executed using index options. And so let's just jump right into an example so you can see how credit spreads on indexes work. So on the first trading day of the year, January 3rd, the SPX index had closed at 3824.14. And let's say that you were now bullish on the index after this sell-off that took place in 2022. And suppose that on that day, you went ahead and pulled up an options chain for options expiring about a month later on February 2nd, and you moved down from the closing price of 38.24 down about 50 points to 37.75, and you went ahead and sold two of those 37.75 put options expiring a month later for a price of $72.65. And you simultaneously bought two of the puts 25 points lower at the 37.50 strike price for a price of $63.70. Well, when you do that, selling two puts below where the market's trading and buying two puts further below where the market is trading for protection, when you do that, you are entering into what options traders refer to as an out-of-the-money put credit spread. And it's a very commonly used strategy among professional options traders when they're bullish, and you'll see why this is actually a bullish trade in a minute. Now, let's first take a look at the cash flow implications of this trade. And as you can see, we are again selling options, selling the 37.75 puts for a price of 72.65. Now, as you know, index options pay off in cash. And in the case of SPX options, they pay off at the rate of $100 per point that the index closes below the strike price of the put option. So you multiply the price by 100, and you sold two of them. So when you multiply it all together, you'll receive cash in the amount of $14,530 for selling those puts. But in this case, we're also going to be buying options, paying $63.70 for those 37.50s, which, as you can see from the same kind of calculation, causes us to pay out $12,740 of the money collected for the protective puts at 37.50, which results in net cash flow after paying for the protective puts of $1,790. And it's also important to realize that your broker will require you to have $3,210 in your account to execute this trade, which is also the trade's worst case scenario. Okay, so now let's move forward a month to February 2nd, the day these options expired. And as you can see, the index did indeed rally, and the index closed at 4179.76 on that day. And so again, if you think about it, it's pretty easy to figure out how the trade turns out, because put options on indexes don't pay off unless the index closes below the put's strike price. Well, in the case of the short options at 37.75 and the long options at 37.50, they are both more than 400 points below the index's final price on February 2nd, resulting in the trader again simply walking away with the $1,790 in cash that he collected a month earlier when he initiated the trade. And so a trader can simply enter this trade every month of the year, and as long as the index closes above the strike price of the short and long options, the trader will be able to walk away from the trade with all the cash flow he initially collected. Of course, if the index had closed below the long strike at 37.50, then the trader would have experienced a full loss of 32.10. Thus, most traders try to place the short and long puts at a good distance below the market to avoid this situation happening very frequently. And so what I'd like you to take away from today's video is that options are not exclusively used as a cheap way of playing a rally on a stock that you like through buying call options. There's a whole world of strategies that involve selling options for monthly income, and the three trades that we shared with you in today's video provide you a glimpse into that world. Options can be used to generate monthly cash flow, and they're a fantastic way of generating that income that you might be seeking.
Okay, if you like the three strategies that we taught you in this video to make monthly income, you're gonna love the zero DTE option strategy, which gives you the potential to capture super quick returns. Just click the video appearing on your screen right now. You shouldn't miss this highly informative and valuable options trading video.